You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? This is Mike from The Moose on the Loose. Happy Monday. Hope that you had an amazing weekend. I spent mine in gymnasiums and arenas, so a lot of like hockey and futsal, but that was good. That was a lot of fun. Now, today, what if I tell you that we're going to talk about a stock that trades above $4,000, actually closer to $4,500 per share, offers a yield of 0.12%. No dividend growth. Would you be interested? Yeah, first reflex, probably you would say, Mike, do you call yourself the dividend guy still? Because, you're completely being ridiculous right now. So bear with me a second, because the first time I heard about that company, I had the exact same reflex. Like, dude, I'm a dividend growth investor. This company doesn't pay even a yield. It doesn't even increase the dividend. So why would I even care about Constellation Software? Well, here's the thing. It's probably the most DSR-like stock there is that tick all the boxes besides one. No dividend growth. All the rest, the business is amazing. And for the fun story, it was on my radar, kept coming back for several years. Like we're talking about like 3, 4, 5 years before I decided to finally take a look at it. Because each time I was thinking, no, the numbers are there, but there's no dividend growth. Completely waste of time. I'm moving on. And when I finally bought Constellation Software a few years ago at $2,000 at 44 a share, yes, $2,000 a share. It was in the exact same situation that it is today, now trading above 4,500. So yes, the stock price more than doubled while I hold this one, and I don't think the growth is over. And it's not even like a volatile stock in a sense that it's like super stable, very large market capitalization, and there is probably less risk investing in this than investing in Enbridge. We're talking about a company that has like close to $100 billion in market cap. So definitely a solid company, but I'm going to tell you a little bit more about it now so you can understand what it's meant to be doing going forward. And of course, as usual, those are like not buy or sell recommendation. Yeah, I really have to do your due diligence on this one and understand how it works. So Constellation Software, software business. Shocker, right? Incredibly smart model though. It's all about growth by acquisitions. And they are acquiring small companies on specific verticals. So they identify small companies offering like software. So we're talking about software as a service, selling licenses, generating recurring revenues, but that are mission critical, like super essential for specific niche business. So think about like something ironically, I discussed that a while ago about automatic data processing that are offering like payroll services. Critical. You cannot run your business without payroll services. Incredibly sticky. But it's a tiny portion of like my budget at Dividend Stocks Rock, for example, as an employer. And for a lot of like businesses, they cannot run their business without their payroll, but they need the payroll anyways, right? So incredibly sticky, incredibly essential for all the businesses, and they grow by acquisition like it's just crazy. So the narrative here, and it's very exciting, I have to warn you, grow by acquisition, but with very low debt. We're talking about a company that generates like a ton load of cash flow and has a market cap of $100 billion and has about a little bit more than $4 billion in debt. So low debt because it's a cash flow machine. Their acquisition playbook is incredible. So they are disciplined, they are decentralized, so they have like specific teams and they have like plenty of verticals. It's just like when you look, it's really the name Constellation gives you the idea. They have like several big verticals such as Volaris, Aris, Jonas, Vela Software, Perseus, and Topicus, and each of them are specialized into different industries. And talking about like software around the industries, we're talking about like financial services, drinks, education, marine, people transportation, clubs and resort, mining, oil and gas, travel, pulp and paper, home builders, real estate, government, legal, automotive, name it, like name an industry. They probably have like a company that offers software that are critical for their operation. It's all there. We're talking about a business that is that focuses on small companies. It could go as low as a business generating like $5 million a year. Imagine $5 million a year when your market cap is 100 billion. Kind of crazy, right? But the thing is, they are investing over $1 billion per year in acquisitions with all those small companies. So they target niche markets with sticky business. Those software are embedded in operation, so very hard to get rid of. And they come in a place where they have a super high reputation. People know that when they come in, they have an amazing playbook. They know how to improve the business. And since they are like very small deals, most venture capitalist firms, they will ignore those deals. So there is less competition on top of that. So they come in with a perfect playbook, a perfect reputation, a bunch of cash, and then there's less competition, so they don't have to overbid to make their acquisition. So that's the narrative. How does it translate into numbers? Because I mean, it's one thing to be excited about narratives, the story, but you need numbers, right? Well, annualized revenue growth, over the past 5 years, 24%. Earnings per share, 18%. Dividend, 0. Why? Because it's all about capital allocation. They're making so much revenue, so much profit, and so much cash from operation. In 2020, it was under 1 billion in cash from operation. Today, we are talking about $2 billion in cash flow from operation. So it has more than doubled in the past 5 years. So just all the numbers are actually backing the narrative. They have this incredibly long pipeline of small companies to buy. So I've sold you CSU, Constellation Software, for the past 7 minutes. What's the risk? Well, of course there are. The first one, I would say valuation. It trades at a crazy P/E ratio at all time. You're going to tell me, Mike, it's overvalued. Yes, it was overvalued at 2000. Now it's overvalued at 4,600. It's likely going to be overvalued at $10,000 a share one day. It's the way it goes. It's being explained for 2 reasons. The first one, as long as it grows that fast, we're talking about crazy numbers, right? We're talking about like earnings and revenue, like 15-20% per year, as still at that size. So they're on for a lot of growth. So you have to pay for that. And the second thing is, with all those acquisitions, sometimes the earnings are going to drop while cash flow is still very high, because you have like expenses related to the transaction, you have amortization, you have reevaluation of some assets and some companies, what they're worth, you have impairment charges. So all of that will affect the earnings. So that is also another thing that you have to consider when you look at the crazy PE ratio. I mean, right now when I look at the Y chart, the current PE ratio is like 99 and the forward is at 35. So those numbers won't make much sense because of the type of business it is. The cash flow from operation keeps on rising, which is super important though. The other biggest risk is how long they can ride this playbook, how long they can continue to make acquisitions, small acquisitions, but make so many that it still move the needles down the line. Because of course, if you're adding for like $25 million in revenue by acquisition for a company that generates so much right now, and we're talking about like $10 billion in revenue now, it's not going to move anything. So the company not only be able to acquire those niche software companies, but a boatload of them every single year. But they have the playbook to do it. They confirm that they have like plenty of pipelines. They have been very discreet as well. Their CEO, Mark Leonard, is like a genius, and he's like doesn't give much conferences, doesn't talk much. He's not really present in media or anything else. He's really like just busy doing his own thing. I think he has built a system, since he focuses on decentralization, that doesn't require his brain today, and the company can continue to evolve. But definitely this one is very, very interesting, even though we have the valuation risk and like potential growth slowdown. So whenever I look at the metrics, I always take a look at how many acquisitions they made, how much has been invested there, what's the revenue, the cash flow from operation, how much is growing, because those are like the key metrics that will tell me if at one point the company is going to slow down or not. It's not easy to pull the trigger with such a complex company with a high PE ratio, and of course a lot of investors will give a lot of thought onto paying like $5,000 a share for a company. But that's the equivalent of like buying like 100 shares of at a lower price. It's all the same thing. It's just like a bigger slice, but you have like less slices. So don't give too much attention to that. It's a crazy numbers, but yes, it worked. So, all right, Moose, I hope that you have enjoyed this one. I hope that I've been able to shed some light around Constellation Software business model. If you have enjoyed this show, please take a second to give me a 5-star rating, or go on the YouTube channel where I put all my Moose on the Loose to just come in and say hi. It's going to be fun to get the conversation going over there. And until tomorrow, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to the Moose on the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.